Well, let's start with the first regular session. João Vitor Isla and Roberto Castelo Branco will present the BRICS Economies, Similarities and Commonalities.
Good afternoon. Well, at this point in time, after almost 15 years since its creation by former Goldman Sachs chief economist Jim O'Neill, the acronym BRICS seems passé, but the real economies behind these 5 letters remain important to economists, political scientists, to strategists such as our president, and to all of us, of course. In this presentation, I will focus on the difference among the BRICS, and later on, Professor Isler will focus on business cycles, co-movements. And why the BRICS are still important? There are several reasons. First, they are large economies. They account for 29% of the global GDP measured at purchasing power parity rates. The 4 original BRICS, Brazil, Russia, India, and China, are among the 10 largest economies in the world. So it's reasonable to assume that they continue to influence the global growth dynamics. One of them, China, the largest, by far the largest BRICS, is actively taking steps to become a major player in global finance, including to reach the status of global reserve currency for the renminbi, and presents itself as addressed by President Carlos Ivan Simonsen as a challenger to the global leadership of the US. And it's a different type of challenger when compared with the Soviet Union, as he properly made. The Soviet Union was a world apart, while China has strong economic interactions with the US in terms of trade of goods and services, FDI and portfolio capital flows, and education. The largest contingent of foreign students in the US are the Chinese. They represent 30% of the foreign students in the US. There are many Chinese PhDs working in the US, many scientific papers co-authored by Chinese and American scholars, and many Chinese in the American academia, including some economic growth specialists. The question is, to borrow the title of a book written by Jonathan Femby, who will participate in the panel discussion later, will China dominate the 21st century? This is the question. In terms of finance, China is willing to extract several benefits from being a global player in this market. The economic growth literature is plenty of evidence of large misallocation of resources among the BRICS. And at the same time, there is a lot to be done in terms of improvement of education in these countries in terms of quantity and quality. So there is high growth potential in the BRICS despite the very fast growth of the last 20 years. As developing economies, several structural transformation is going to take place in the future, with China going from investment, manufacturing economy to much more consumption service-driven. There is urbanization going on in China and India. In these countries, structural transformation in service from traditional to modern service. All these structural transformation is going to have very important effects to present challenges and to generate spillovers into the rest of the global economy. Last but not least, recently, there is the formalization of the BRICS as a group of nations with regular annual summits. And let us see the implications of this. Is it just a piece in the Chinese chess game, or it will generate real income benefits through greater economic integration? China, in the past, was a very typical case of growth disasters. According to Angus Madison, by 1820, China accounted for 33% of the global GDP. And by the late 70s, it was less than 5% of the global GDP. But now there was a resurgence. China grew very fast. It represents about 16% of the global GDP and 55% of the aggregate GDP of the BRICS. And it's number one or number two in every dimension we can imagine, as shown by this slide. But despite this extraordinary progress, China is still behind in the convergence path. Its per capita real output is less than 20% of the US. It has a large pocket of poverty. According to the World Bank, 31% of the Chinese population lives with less than $2 a day, has a monetary income of less than $2 a day. So it's a mixed economy with growing inequality taking place. In the Chinese quest for global power in finance, China developed several initiatives. One of them is the creation of new multilateral finance institutions, the NDB, so the Bank of the BRICS, the Silk Road Infrastructure Fund that's seems dedicated to finance the transportation infrastructure linking China to Europe through Central Asia, a former Soviet territory, and also the building of oil and gas pipelines linking the so-called stands to China in order to supply China with natural gas and oil. China started to recycle the current account surplus through foreign direct investments instead of just accumulating official international reserves. Over the last few years, the FDI outflows have been accelerated. Over the last 10 years, according to the statistics of National Bureau of Statistics of China, as the accumulated FDI outflows amounted to $580 billion. The largest recipients were the US, Australia, and Canada, but the focus was natural resource. About 75% was destined primarily to mining and oil and gas. Out of the 10 largest recipients of Chinese external investments, 7 of them are natural resource-rich countries, such as Australia, Brazil, Canada, Russia, Peru, Kazakhstan, and others. And China, compared to Japan, which was hungry for natural resource in the past, they had different models. Japan had a very clear model. It used the private sector trading companies to be the investors, entering into JVs with local players, while the lenders were the state-owned banks. China started with very aggressively with state-owned companies taking over the control of local companies or trying to develop it by themselves projects, and it didn't work well. So now China has a more mixed model with the presence of private sector company jointly with the state-owned company taking minority stakes or entering into JVs with local companies. And there is a different characteristics as well. About 25% of the Chinese financial flows, both foreign direct investment and loans, have been extended to what we classify as high-risk countries, countries with little or no access to global financial markets, such as Argentina, Venezuela, Guinea, Zimbabwe, the Democratic Republic of Congo, and others. The goal is to get long-term contracts to supply China with natural resource, and these contracts are attached with the award of engineering and construction contracts, and also the export of equipment. In its way to pursue the status of global reserve currency, China, for the renminbi, China is developing several initiatives. First, it entered with a large number of countries into bilateral currency swap agreements, totaling almost 500 billion US dollars. Second, there was the gradual liberalization of capital inflows and outflows. And these initiatives included also the use of Hong Kong. Hong Kong is a major international financial center as a place for the settlement of renminbi-denominated transactions, and the creation of a bond market, the so-called dim sum bond market, which is still small, with the issuance value very little, about $20 billion, as the last figure at least I know in 2013. And finally, last year, there was the creation of the Shanghai Stock Exchange, Hong Kong Stock Exchange Connect, the HKG Connect, linking the two large stock exchanges, trying to transform them into one single stock market to open the Chinese stock market to foreign flows. So China, with these initiatives, is looking to gain some very clear economic benefits. First, those associated to a country which has a global reserve currency. China, if it's successful, to be the first emerging market economy to have a currency with such a status. But we believe that they are far from reaching this, at least because two of the necessary conditions are lacking. First, to have a flexible exchange rate regime, and the market for the renminbi is still tightly managed. Second, to have a large domestic debt market, which doesn't exist at this point in time. As a closer integration with global financial markets, that it's important in order to facilitate the restructuring of the still dysfunctional Chinese internal financial market, the diversification of the foreign asset portfolio, which was too concentrated in sovereign bonds of the US and Europe and Japan, the diversification of the household asset portfolio. Households in China, they have almost 75% of their investment portfolio concentrated in real estate assets. It's similar to Japan in the pre-real estate bubble years of the 80s. So it is useful, it's advisable to have a little more diversification. And last but not least, the exploitation of comparative advantage of China in infrastructure building. There was a lot of learning by doing in the Chinese construction and engineering service industry due to the huge investments in infrastructure and also in standardized capital goods. Coming to the dissimilarities and commonalities. The BRICS share some of the typical commonalities of emerging market economies, which are weak institutions, low education levels, large misallocation of resource, higher volatility of economic activity, and a lower per capita output. But on the other hand, they have several dissimilarities. As I'm going to show you, heterogeneity stands out as a key feature of these countries. In terms of economic structure, Brazil resembles the economic structure of a mature, developed economy, with consumption, if you add public to private consumption, it represents 85% of aggregate demand. Over the last 10 years, aggregate demand in Brazil was almost 100% driven by consumption expansion. Brazil is an urban country. Services represent a large part of output and employment. This contrasts with China. China is an investment-driven economy which played a major role over the years in terms of expansion of aggregate demand. Investment is very high, represents 49% of the GDP, which is high even by the Asian standards, compared to other successful Asian economies in the growth process. It's measured only by the brief period of the Singaporean experience, the late 70s, early 80s. Brazil is a large net importer of capital, contrasts with China, which is a large net exporter of capital. According to the evidence provided by Prasad and Hajam, there is a positive correlation between current account surplus and economic growth rates, suggesting that the deficit countries don't have financial markets efficiently, with efficiency to allocate foreign funds in an efficient way, or they are prone to the overvaluation of their own currency. Perhaps this happened with Brazil, which is a large net import of capital, and it's the experience of growth since the 80s has been characterized by relatively slow growth. India follows in terms of investment to GDP ratio, follows the experience of other successful Asian economies, but with the adoption, with of a different model. Instead of concentrating on the investment of export-oriented manufactured goods supported by cheap labor, India is more focused on high-tech, capital-intensive industries such as information technology, medical service, pharmaceutical industry. On the supply side, China is an industrial economy with a very large industrial sector, accounting for 45% of GDP. Manufacturing accounts for 32% of GDP, is more than the double of the share of the average share in other emerging market economies, which is around 15%. The service sector in Brazil and South Africa are very large, almost 70% of output and employment, which presents a very good opportunity for a boost in total factor productivity growth. In general, total factor productivity in the service sector tends to catch up to developed levels much more slowly done in agriculture and manufacturing. So there is an opportunity for boosting total factor productivity and, as a consequence, economic growth through the turning around these, the service sector, both in Brazil and South Africa, to create more growth. They are large sectors, and there are externalities to the other sectors of the economy because agriculture, mining, oil and gas, manufacturing, all of them are consumer of service. The service sector in China is too small, only 43% of GDP, and it's underdeveloped. Only 15% of the labor force is high skilled in China, in the service sector. This contrasts even with Brazil with 23%, China with 25%, and of course with Korea with 51%, and Korea is a benchmark for a successful emerging market economy. In international trade, there are many dissimilarities. There is a sharp contrast between the other BRICS, which are relatively open economies with the trade of goods and service representing more than 50% of GDP, while in Brazil it's just 28%. And with the manufacturing industry is vertically integrated. We are not a player in the global supply chain. This is a major source of low productivity in Brazil. We know that the exposure to global competition influence productivity at least to three channels. First, it raised the stakes. It forced companies to become more efficient in order to survive in face of external competition. Second, there is a selection effect. The more innovative, more efficient companies tend to grow, having a larger market. On the contrary, the less efficient companies tend to shrink into exit markets. And finally, there is a diffusion of ideas that embodied in international trade. There are very complementary comparative advantages among the BRICS. While Brazil, Russia, and South Africa are large commodity exporters, they are natural resource powerhouse, and they are suffering the real income loss derived from the end of the commodity price super cycle. India and China are large importers and are major beneficiaries of the plunge in commodity price. China is a large exporter of manufactured goods, and India is a large exporter of service. The complementarity contributes to trade links among these countries. For instance, China is the main destination for Brazilian, Russia, and South African exports, and the second main destination for Indian exports. In terms of urbanization, China and India are yet to urbanize. China is a little more advanced, and China is not making the mistakes Brazil made when it was urbanizing. China is investing a lot in education, infrastructure, and housing. Brazil failed to do this. This is the reason of inequality, the presence of slums, and it caused a dent on economic growth. So this is another structural transformation that at the same time is a challenge for these countries, for both China and India, but it has a high expected payoff through the reallocation of labor from the rural sector to the urban sector, and also from the diffusion of ideas provided by the formation of cities. In terms of demographic transition, India and South Africa have very young populations. The demographic dividend is expected to last through 2040, while Brazil is facing a rising dependence ratio from 2030 on, and China earlier in 2020. The case of Russia, Russia has an old population. As a matter of fact, it's decreasing, so it's a major challenge among all other challenges the Russian economy faces. Well, all the BRICS currently are facing various types of challenges. With the end of the commodity price supercycle, the various financial crises in the US in 2008, 2009, 2010, 2011 in Europe, and the economic policy response to this crisis slowed growth. And fundamentally, this is a productivity problem. There is a slow growth in productivity in all these countries, and of course, economic development is a productivity problem. Back in 1954, Eugênio Goudin, who is a founding father of economics at Fundação Getúlio Vargas, wrote a paper published in the Revista Brasileira de Economia. The first line he was saying, the most serious problem of this country is the lack of productivity. And then for comparisons between Brazil and the US and Brazil, Argentina, at that time was a different country, a different economy. Well, out of these 5 economies, only 2 of them are China and India, these other dissimilarity that are launching reform programs. And I am not going to delve into each of the items of these programs for China and India, but on a single item. Both China more aggressive, India not, both have anti-corruption initiatives. Corruption is not only a legal problem, but it's a killer of productivity, as it creates barriers to competition and disincentivizes innovation that are key for productivity growth and development. So now I'll pass to Professor Isla to continue with the commonalities, the business cycles movement.
So I'll try to be brief because I understand I'm the only thing standing between you and a coffee break. So this is joint work with Roberto and Bruno de la Libera, sitting there. So we're going to, this talks about similarities. And of course, we're going to be a little bit formal in defining, we're going to test for that. We're going to use econometric techniques. So I have to explain a little bit what they are. And as the title says, we're going to be using common features, which I'm going to define now. So suppose one series or one economic variable has some property, let's call it property A, and another series also has the same property. A common feature is when there exists a linear combination of the two series, like that, that does not have the property A. Okay? So the linear combination eliminates the property. That's why it's a feature and it's common to both series. Now, as you know, co-integration, meaning that two series, they grow at the same rate in the long run. That's perhaps the best well-known example of common features. But I would like to think that common cycles or common serial correlation is another well-known property of, or another good example of common features. Because I have been working on that for 20 years, so I hope. So in this case, so let me be a little bit, let me show you a main example in the first paper on common features. That was by Engel and Kozicki in the, thank you. That was by Engel and Kozicki in the early 90s. Sharon Kozicki was a colleague of mine at UCSD, and we both worked with Rob Engel. So they took the growth rates of GDP for the US and for Canada. Sharon Kozicki was Canadian, so. And of course, in the long run, they grew at different rates. We all knew that. But in the short term, the growth rates were very similar. So that was their example of common features, okay? So the cycles in growth were synchronized. If I may, I can use like an idea of, you know, having two waves going to two different beaches, but they go at the same pace, simultaneously. So that's the idea. It's a dynamic thing, but it happens more or less synchronized. So that's their example. And that's more or less what we're going to find here for the BRICS as a commonality. We're going to show to you that growth rates of GDP, they are synchronized. And the same will be true also for industrial production to a lesser extent. So let me just show you a model. Going back to the example in Engel and Kozicki, so you can think of the growth rate of the US here, growth rate of Canada. F is the growth factor, okay? As you can see. And it's present in the US with coefficient lambda and present in Canada with coefficient 1, okay? And these two terms at the end here, they are shocks. They're completely random shocks. So if I didn't have the shocks here, the growth rate would be proportional to each other, right? So if I knew the rate Canada was growing, I knew the rate exactly the rate US was growing, and vice versa. So that's very uninteresting because, you know, that says that US and Canada, you can predict one knowing the other. But adding the error term here that's random makes the model more interesting and more reliable as well, and not counterfactual, because we know that the growth rates of Canada and the US are not proportional. So the idea is to try to find a combination, and the combination that kills the common factor f, the growth factor, let's call it, is 1 minus lambda. So if I apply this combination to the growth rates, like that, I eliminate the f part. I only get the random part. And that linear combination is completely unpredictable. Okay? So formally, our tests are going to look for this combination. Okay? And check whether or not the combination is unpredictable or not. And if it is, we're going to say, yes, there is a common cycle. Okay? So let's try to explain that with one picture, or maybe two. These are cycles. Cycles for Brazil, Russia, China, and South Africa. I don't have India here for the reason that the cycle the growth cycle in India is completely unpredictable itself. So it doesn't have the property A, the one I mentioned at the beginning. Okay? So as you can see, the growth pattern is more or less the same. There was, this is the cycle, growth cycle, if you wish. And as you can see, they were growing. The cycle was high here in the beginning of the 2000s, reduced and went up again just a little bit before the Great Recession. All countries went into recession at the same time. And most of them recovered at the same time as well. Of course, that's not perfectly synchronized, but like I mentioned, the difference is if they are random, this is synchronized enough for us, okay? And for the tests we're going to apply. And as you can see at the end here, the cycles are decreasing after the end of the recession, the Great Recession as well. So let's look, instead of looking at the cycles of growth, let's look at the growth rates. Because, you know, the first slide I defined common features as based on the growth rates of GDP. So let's look at that. As you can see, the same here. They all reduced in the Great Recession and they are going down again. These are all standardized to make a better picture for you. And as you can see as well, for example, the growth rate of China, there are spikes here and there. Brazil also, there are spikes here and there. So they do not conform exactly to a factor model because they have these random shocks. But as long as the shocks are random, there is a common part that's explained by the factor, and that's good enough for us. Okay? So as you can see again, there is this dip here in the Great Recession. But now the growth rates are slower than just in the aftermath. So I'm not going to bother with slides with the models. I think that's too much maybe for here, but just for the sake of completeness, this is the model we are going to think of. It allows some long-run relationships between the GDP series. This part is the growth part that's explained by these variables. So at the end of the day, you want some linear combinations of the growth rates that do not depend on the series that are non-random here, on this part. So that's why I have the 0 in the linear combination. And the way you're going to test for that is going to use a generalized method of moment approach. So there is a test that goes with that to verify whether or not the linear combination is not correlated with the series in this part here. So that's essentially the test. The growth rates that are explained by these terms. So if they are not correlated with the terms here, they are unpredictable. And that's the test. So let's go to the results. So this is GDP for the countries. As I mentioned before, I don't have India because India has a growth cycle. Growth is random. And these are p-values. So anything that's bigger than 0.1 shows a common cycle. And as you can see, there are common cycles everywhere for pairs of countries. So here, Brazil and China, they have a common cycle. If that number was smaller than 0.1, there wouldn't be a common cycle, but it's bigger, so we have a common cycle. Again, here and there, everywhere. So everything that you see as bold in these tables, we have common cycles. And here we have common cycles for every pair of country except India, but India doesn't have a cycle. So it doesn't make sense to test for one. So let's look for industrial production now. That's a very nice picture because it's the cycles in industrial productions. They are normalized. Yeah, of course, there are spikes here and there for different countries and different times, but we can see a lot in common as well, right? We can also see that they all dipped in the recession, the Great Recession, and they recovered. Now they are growing a little bit smaller, but there's a lot in common, as you can see from this picture. So we're going to look for the pattern as well, using the same testing procedures. Oh, and by now, India is included because the industrial production in India has a cycle, whereas the GDP of India didn't have a growth cycle. So just to point out, Brazil and Russia have a common cycle, as you can see in industrial production. And the correlation between the two cycles is 0.6, which is pretty big. Brazil and South Africa also have a common cycle. Correlation is a little bit bigger, 0.63. And the formal testing here. As you can see, Brazil, Russia, and South Africa, they are synchronized as Brazil and Russia and Brazil and South Africa. And also we find synchronization between China and Russia. Now, this part is easy to explain because Brazil, like Roberto said in his presentation, Brazil, Russia, and South Africa are exporters of commodities. I don't have a good explanation for China and Russia, but maybe some of you will, I don't know. But other than that, we don't have synchronization. So we have less synchronization here in the case of industrial production than we did in the case of GDP, right? Because in GDP, every pair of country, they shared common cycles, but not industrial productions. If you go to exports, nothing. No synchronization whatsoever, which is surprising, or maybe not. I mean, Brazil, Russia, and South Africa are exporters of commodities, but still, perhaps they are different commodities, and also exports doesn't include only commodities, includes other sources as well. But we didn't find any synchronicity here. If you look at imports, then we find Brazil and Russia with similar cycles in imports, and India and South Africa, but other than that, not much either. So now let's look at a different group of countries. We're looking at commonalities only within the BRICS group, but we thought it was interesting to look beyond that. So let's look at the US and see whether or not GDP of the US or industrial production of the US was synchronized with those of the BRICS countries. And as you can see, apart from Brazil, so I used the cutoff of 0.1, so this is pretty close, but not yet. So we found synchronization for China in the US, India in the US, Russia in the US, and South Africa in the US, in terms of industrial production. No, this is industrial production. So everything that's included, manufacturing is a part of that. So, and for GDP, again, disregarding India because it doesn't have a cycle, we found commonalities between US and all the countries except of India, but India has no cycle in GDP. So if you look now at the euro area, nothing industrial production, nothing at all, no synchronization. But GDP, again, find synchronization here with every country in the BRICS group. So let me say a few words about the results. I forgot to mention that this is work in progress. So we have like, I don't know, parts of a paper, not a full paper yet. But as soon as it becomes available, the home page will have it. So let me make a few notes about what we can conclude from all that evidence. First thing, we wanted to take the most recent data in testing for common cycles. So we started in the 2000 all the way to 2014. This is quarterly data for GDP. Industrial production is monthly data. So if I had used older data, then perhaps the result would be very different. Let me give you a few examples of that. So I have one of the papers of the common feature literature actually got published in the Revista Brasileira de Economia in the early 90s. We tested for common cycles Latin America and compared that to the US. So instead of finding synchronization, we found reverse synchronization in the sense that cycles in Latin America were the opposite of cycles in the US. So it was a very interesting result. But remember, and that used data from the 50s to the end of the 80s. So at that time, the world was very different than it is today, and especially in terms of globalization, market integration, and all that. So I think if we have used data going back to the 50s, we wouldn't find such a nice pictures as those. Okay, so that's one point to make. Second point, why did we find so much synchronization among GDP figures and not regarding industrial production? GDP is quarterly and measured in quarterly data, and industrial production is monthly. So it's higher frequency. And as you aggregate over time, you make the city smoother, so you give more chance to synchronization, as if you can think of it like that, okay? And of course, quarterly data, then that's what we found, more synchronization. And a final issue is that finding similar results to emerging economies, we weren't the first to find that. So actually, Ezra Prasad, I don't know if he's here or not, but he's in this conference, he's talking tomorrow, has a very interesting book and another paper as well, that he looks for common behavior or common factors, which is the same as common features, if you wish, for emerging economies. And also look at the relationship of the emerging economies vis-a-vis the developed economies. And he finds that the emerging economies, they are very similar amongst themselves, but not so similar when you compare them to the developed countries. So here, but he used data from the 60s onward, and we're using a different database, starting in 2000. So perhaps that's so it's similar to his results, but we found also commonality between the BRICS group and the developed countries represented by the US and the Euro area. So that's different from his result, but more or less in the same lines. And perhaps he's going to say a few words about this tomorrow, I don't know. So that was my presentation. So I think we may have couple of questions, I don't know, or yes? So let's open the floor for questions, please. For me or to Roberto?
Have you run the model with the quarterly data for industrial production as well? Because you were saying just to...
No, we didn't. But that's a good thing to do, yeah. To compare with GDP to be fair. That can be done. That's easy.